Hi everyone. Today I am super excited to have Mr. Ajay Vaswani on our podcast today. We will be covering a lot of India tax topics, and I'm really excited to have someone like Ajay demystifying a lot of these questions, particularly around NRI taxation. To give a flavor of, about Ajay has been into NRI taxation for more than 13 years, and unlike many CAs, he particularly focuses on NRIs, and that is, I think, the best part what I like about him. But Ajay, here's to you, to give a quick glimpse on about your work and how you help NRIs around the world.
Thank you, Hemant, first of all, having me on this podcast. Always exciting to interact with you. The way you have been doing for NRI community at large, I am very happy to see. Yeah, it's a good always that we interact on the NRI taxation front for the very reason that NRIs are ignorant in India about the do's and don'ts. That is where I come in. It's been 13 constant years now that I've been helping NRIs on this part. So for that reason, I don't have even a single resident client. By qualification, I am a chartered accountant, company secretary. Plus, I did a dual graduation in commerce and law. So this gives me an all-around edge. And particularly, it's not just about the taxation thing. Plus, FEMA comes into picture, and then handling of the real estate transactions for the NRIs, the remittances of the proceeds that eventually you have of money in India, you want to remit back to the outside country. So all these things I have been doing for 13 years now, constantly.
Great, great. Really excited to have someone so experienced like you to, have answer these questions that we have on the list now. So without further ado, let me get this quickly running today. So, first question is, a lot of NRIs feel like they don't have to file taxes in India. And this is particularly because they have moved outside for a long time, and they feel like they don't have much income, or they may have some income, but it's within the limit. Important question is filing income tax return necessary for NRIs? Or maybe, put differently, when should NRIs file taxes in India?
So of course, when you move outside India, you stay out for 2, 3 years. You are more ignorant on the India part because you are in a communication gap. Eventually, you are more on a country where you are actually living. You are focused on the income part there, compliance is there, and accidentally, I have seen a lot of NRIs missing up on this part. And at times, I also see that they have been misguided. So they would ask their relative, friends, or known ones in India that what should I do, and eventually, the person who they are referring to are not the experts on this. So for that reason also I have seen NRIs being missed upon this part. So it is very important for a non-resident Indian to be compliant in India, and Income Tax India requires a non-resident Indian to file income tax return in India on 2, 3 grounds. Number one is if your income exceeds the basic exemption limit. That is, if I'm talking for financial year 24-25, the good date, the primary due date for filing the tax return for this is 31st July. You can file your ITR for financial year 24-25 up to 31st July. So in your financial year 24-25, if your income exceeded rupees 2,50,000, in that scenario, it is mandatory for you to file ITR. Second reason is if you have any capital gain. So for NRI, there is no slab rate benefit available while you're computing tax on the capital gain. So if you have a long-term capital gain, for example, say 2 lakh rupees, 25,000 is exempt. Balance 75,000 is taxable for you even if this income is below the exemption limit. Third is a dividend income. If you have any dividend income for NRI, it is taxable at 20% flat rate. This is not slabs, unlike for a resident Indian. And fourth is, of course, you should be filing ITR when you have to claim TDS from the government. So any income that is paid or credited to an non-resident Indian, TDS is deducted at a higher rate. So if it is a sale of a mobile property, TDS is at 12.5%. If you have interest income, it is 30%. So always it is on a higher rate. Only condition for you to claim the refund from the department is to file the income tax return in India. And the last and the most important point is when you should be filing ITR is in case you have a long-term capital loss or a short-term capital loss which you want to set off and carry forward. So there is a benefit available where if you file the ITR before 1st July, you can carry forward and set off the loss up to 8 years. So tomorrow, next 2, 3 years, if you have any capital gain coming in, you can set off the carry forward loss. Eventually, this is a good tax planning that NRIs can do.
And I think one reason to also file taxes would be to have a financial proof or some kind of a documentation, particularly from the ITR department that, someone as a taxpayer would need, right? Is that right?
This is a voluntary benefit that you get. Eventually, if I ask you, Hemant, you being a non-resident Indian, what is one document in India for you that substantiates your residential status and the proof of income. So it is only income tax return in India which eventually helps you in doing the same. So this gives more credibility, better financial records. Tomorrow, maybe you come back to India and become resident for good. And maybe if you have to apply for a loan, be it any kind of loan, banker would ask a financial document that is income tax return for 2 years at least. So primarily they ask for 3 years, but you can file ITR in India only for 1 year at a time. So how about the second year? I have seen people suffering for that reason. So they have to wait for the year to close, file the ITR, and then become eligible to even apply for a home loan or an education loan or any other type of loan that you have to take in India.
Right, right. Okay, so I want to explore certain heads or different topics where income tax or ITR should be filed, and also how to claim TDS if it has been deducted. So one, I think a common case where a lot of NRIs may have properties in India and they kind of sell it off. There is a TDS which is deducted, and it could be at a higher rate if not claimed earlier. So what is the right process to kind of navigate this situation?
Okay, so this has been a very frequent question for the non-residents. If you are a non-resident Indian, if you are selling a property in India, irrespective of the sale value, TDS, if it is a long-term capital asset, is deducted at a rate of 12.5% plus surcharge and plus education cess. So, for example, if you're selling a property which is about 2 crore rupee, your effective TDS rate, including surcharge and education cess, goes to 16.25%. And in another word, TDS is also called as withholding tax. So withholding tax is on the sale value. And eventually the tax liability that you have to pay to the government is on the gain value itself. But obvious, government is collecting a more amount than your actual tax liability. So for this reason, you have two options available now. One is after the end of the financial year, you file the ITR, and whatever is the excess money, you claim it as a refund. So, but obvious, if you are selling the property right now, just in the start of the inception of the financial year, your financial year closes on 31st March. Return would be filed in June, July. Considering the amount on the higher side, government might take 1 to 3 months for the refund to be processed. So practically, what is happening is your money is stuck with the government for no reason for a period anywhere between 12 to 18 months on an average. The alternative here available is you can apply for a lower TDS certificate. So once you have identified the buyer, you need to apply for an online application to your jurisdictional income tax officer, explaining him that, see, this is the transaction I'm doing. This is my eventual tax liability. Based on that, you can get a lower TDS certificate, which will be equal to your net tax liability to the government of India. So that you give the certificate to the buyer. In that scenario, there is no question of excess TDS or withholding tax being collected by the government. So NRIs should take the advantage of applying for a lower TDS.
Got it. Got it. And how about like simple cases where they have like many people may have, just bank accounts, which basically accrues interest and there is a TDS deducted on that. And sometimes these accounts would be very minor in nature, like, just small amounts. Is income tax should be filed in that case also?
Primarily, as a non-resident Indian, you can have two bank accounts. One is NRO and NRE. So as a non-resident Indian, you cannot continue having a saving account. It is mandatory for you to convert all your saving accounts into NRO. And whatever interest you get on NRO account is taxable for you. NRE is of course exempt, so there is no question of paying tax on the NRE interest. But in NRO, you have two types of income again. One is from the saving account and another is from a fixed deposit that you have. I have seen a misconception again in the non-resident is, for example, if you have a NRO fixed deposit which is cumulative in nature for 5 years. So, but obvious, whatever interest you get every year is it is cumulated and reinvested, and in end of the or the maturity of the deposit, you get the credit of the income.
Hmm.
This income, what you get at the end of the period where your fixed deposit is created, it is not the income for the end of the year. It is an income which is accrued every year to you and reinvested. So this should become part of your taxable income, first of all, for every year. And second, as I mentioned, 30% TDS is applicable on any interest that you get on the NRO account.
Hmm.
So, but obvious, there would be a good amount of withholding tax done on your NRO interest. You should log into your income tax portal, check the 26 AS. That is where you get the information what is the TDS deducted. You
Hmm.
file your ITR, you can claim this entire amount as a refund or adjust it to your eventual tax liability.
Hmm.
Hemant, I will tell you, I have seen people, I have been filing ITR for NI for years. I have seen people getting refund from ranging on an average 20,000 to even 2 lakh rupees for that matter.
Yeah.
NRIs are not aware absolutely because they don't log into the tax portal and see the 26 year statement.
Mm.
Drawback is from a foreign IP address, you cannot log into the tax portal and see your 26A
Mm.
statement. So that is
Mm.
a restriction. So you will have to take assistance on that part to see your 26.
Yeah. So I think this is an important note to all NRIs where many of them would be leaving money on the table because either they are, they're not aware of this process, or they just feel like, tax is cut and that was supposed to be cut anyway by the government. But because it's within the limit, they can rightly claim this as a refund and can actually, gain out of it, the process, right? Is that correct?
Absolutely. And there is again a very wrong notion in the NRI community. There
Hmm.
are two things now. So paying TDS and paying income tax or filing income tax return. People are a notion that TDS has been deducted and they have done the compliance.
Yeah.
That is not the eventual compliance. Compliance is you need to compute what is your total income, declare to the income tax return India by filing the ITR in India. That is the compliance that government of India is looking for. Tax is not just one thing. You have to file your ITR and tell the government these are my sources of income, this is my total tax liability, this is the amount payable or refundable as the case may be.
Thanks for clarifying. I think that really drives one important point where people feel tax is deducted and it's done. However, it's very important to report this and make sure numbers tally as according to from the government and as well as what you voluntarily report.
True that, yeah.
Yeah, great. Many NRIs also have mutual funds or stock investments. Anything particular you want to highlight with respect to that? Like because
So
this come under capital gains, right? Yeah.
yeah, so under the capital gain, primarily you have asset under two category, either immovable or movable. Immovable, it is taxable as per the long term, short term. Long term is 12.5%, short term is there. And similarly, there is a category in movable asset wherein you have assets like stocks, mutual funds, debt funds. Okay. So there are various category. Every investment that you do under capital gain, you have to primarily see what is the period of holding to ascertain either it is a long term capital gain or short term capital gain. So if I have to give you an example, like mutual fund is the most popular category in the capital gain. So if you have been holding the asset for more than 12 months, this is classified as long-term capital gain. On that, you have to pay 12.5% tax. First 1,25,000 is exempt. However, if it is a short-term capital gain, means your period of holding is less than 12 months, it is taxable at a rate of 20%.
Mm, understood. And how about, let's say, many NRIs don't file taxes sometimes. Let's say may have moved and may feel like they don't have to. Now they come to, let's say, realize that, hey, now they have to file taxes. So can they file previous year taxes? Is there a way to amend anything? Please share more on that.
So primarily there are two things. One is if you had an income which is over and above the taxable limit,
Hmm.
it was mandatory for you to file ITR. In case you have missed upon that, of course, penalties can come in. And second is a voluntary part. If you don't have a taxable income, then it is fine. Absolutely, Government of India doesn't say for you it is mandatory to file ITR in India. And considering that you had a taxable income, primarily you can file ITR in India only for 1 year at a time, and 31st July is the primary due date. In case you miss upon this primary due date of 31st July, you can still file ITR in India till 31st of December of the same year. And of course, there are certain disadvantages. Number one being there is a penalty applicable, which ranges from either 1,000 to rupees 5,000 depending upon the income.
Hmm.
Second is you cannot file for a revised income tax return if you are filing this belated return. So tomorrow, if you see any mistake happening in your ITR, you cannot file for a revised ITR. However, if you have filed a primary due date return, that is before 31st July, and tomorrow you see any mistake in the income tax return, you can file for a revision n number of times.
Hmm.
Third is if you're filing the ITR before due date, you can carry forward the loss up to 8 years I mentioned. However, if it is a belated return, you can set off the loss, but you cannot carry it forward for 8 years. So this is the advantage if you're filing your ITR before 31st July. There is another concept which was even recently amended. It is called as ITR-U,
Hmm.
which means updated return. So government says if you had a taxable Indian income and there is a tax payable on that, you can file ITR for 4 previous years by paying additional tax liability which ranges from 25% to 70% and pay off the tax liability, interest and all whatever together and be compliant in India. So tomorrow if Government of India knows that you have not filed tax return in India and you had a tax liability, they can go and levy additional tax or a penalty which goes even up to 200%. So it is
Wow.
better you voluntarily file and pay on a nominal penalty and clear your file.
Yeah, I think this is a quite important point where you highlight uh, the consequences, of not doing timely filing. And I think a lot of people assume that it's okay or it won't be high because they have minor amounts in their bank account, or may just feel like, because they're not no longer the tax resident of India, or they're living in a certain country, they feel like it's not an obligation, but rather it is very important, as I understand.
Hemant, today the scenario in India is income tax department knows more about you. So every transaction, every income that you have is linked to your PAN, and there is a report called as AIS and TIS
Hmm.
where all the transactions are reported, all major transactions. So I will
Hmm.
give you an experience. Last year I was filing an ITR and I had included some interest income on an account which was to the tune of around 4-5 lakh rupees. This was from a fixed deposit coming in. It was a small bank primarily. Indian said, Ajay, this is not my bank account and this is not an interest which is belonging to me. I was amused and surprised. Why would an individual say this is not my account or a deposit and this income which was being showed is not my income also? I
Hmm.
just cautioned him and said, go to this particular bank. Account number was mentioned in the AIS report. I asked him to check with the bank. Later on, he found that this bank account was of his father and which eventually he got through the nomination process. And he was absolutely not aware that his father had a bank account.
Okay.
So this is the information now income tax is telling you.
So I want to double click on AIS and 26 years. A lot of NRIs sometimes are unaware. Like many times, what happen is like students move to the foreign country for studying and they kind of start living there. They may have certain accounts or may inherit, as you said, or may just pass on from family, but they are unaware of these technical terms. So would you mind to kind of just share quickly on what is the AIS, what is 26 years, and what exact documentation does the government have on each taxpayer?
So 26 AS is nothing but a summary of all the income that have been paid to you on which TDS has been deducted. So TDS summary is shown in the 26 AS statement, and then there are additional two. These are very recent thing. It has been introduced couple of years back. AIS annual information statement and TIS is transaction information statement. The transactions that you have been doing in India. So primarily, if I have to give you an example, you buy and sell mutual funds. The portal wherever you are buying and selling eventually reports to the government or the income tax that these transactions are done on your PAN. So it shows what is the volume of mutual funds you have bought, what is the volume of shares you have sold, any immovable property bought and sold, what are the remittance that you have done inside outside India, what is the interest you have got, what is the dividend income you have got. So it shows the narration of all the major transactions you have done throughout the year, which are linked to your PAN.
No, that makes a lot of sense. I think, and as digitization of records is happening, and many financial institutions now are obligated to even report these transactions, it is very hard to skip this, fact that the Indian government knows a lot more about you now. And it's no longer, I think, an option to kind of skip ITR filing, even for non-residents.
Absolutely. Everything is AI driven now. So income tax also has adopted the AI mechanism. Everything is digitized. At a click of button, they get the information available.
Hmm. Hmm. And just to double click on the types of income, so we kind of share our, kind of discussed on property sale, interest income, mutual funds, rental income, let's say. What other forms of income could be possible that people might be assuming that, this is not taxable? For example, this could be, let's say, from an insurance, something like they get as a proceed, or let's say even pension. A lot of sometimes senior people, they receive pension. And what other maybe, sources of income are taxable, which might be overlooked?
So primarily income tax classify any income that you get in India in five major heads. Number one is salary. I hardly see NRIs getting or deriving any salary in India.
Hmm.
Second is business and profession.
Hmm.
Very few actually NRIs have any business interest in India. So if you have any interest, that business income is becoming part of your total taxable income that you have to take care. Third is capital gain. Capital gain again primarily is from movable and immovable assets we have talked about. Fourth is house property. So it means any income that you are getting as a rental receipt or letting of a immovable property in India becomes part of your total taxable income. Here there are two, three certain advantages available. First of all, whatever rental receipt you get, it is not that the 100% of the amount is taxable for you. You get first of all two deductions. One is for the municipal taxes that you pay on the actual basis in the same financial year, and second, But obviously, you would be having a house, you spend some money on the repair maintenance, reductions around the interiors or something you are maintaining or plumbing thing. So government has an intention that they give you deduction or allowance for that part. But considering the number of SSC and number of house property, it is very difficult to match one on one. So government gives you a standard deduction of 30%. Now, irrespective of the fact that you do the expenditure or not, whatever income you get minus municipal taxes, take 30% reduction, balance becomes part of your total taxable income. Okay. And of course, there are advantages. If you have taken a loan, home loan on the property, you get the deduction of the interest, you get the deduction of the principal amount,
Mm.
depending upon the limit you are into and which regime you are opting. There are classifications around. And the last head is other sources. So whatever is not classifiable into the four major heads is put in other sources like interest on your PPF account, your insurance money that coming as an income, or for that reason, your interest income on deposits, saving account is all classified into other sources.
Right, right. Understood. And when it comes to like claiming benefits, there are some certain sections like ATC, ATT, ATG. Are these
Yeah.
sections available for NRIs to claim benefits as well?
So primarily in India now there are two regimes. One is old regime where you get the benefit of the deductions, and another is a new regime where government has given a better tax slabs and eventually reducing your tax liability without the investments. Our survey was there around 73 to 74% people opted for a new tax regime for the very reason it is giving you better tax slabs without any commitment to do the investments in India. So probably it is matter of time. India is going to scrap the old regime wherein you used to get the benefits of reduction and moving towards a new regime. That is how you rationalize the taxation structure in India. So government of India is moving on that direction. Whenever we are filing the income tax return in India, what we do is today we compute the tax liability under both the regimes for the given the set of income and the deductions for the NRI that they have done, and whatever is more beneficial we opt accordingly.
Okay, so that's a great point. Like, I think as long as both regimes exist, it is beneficial in the case of NRIs, and especially what you are doing to kind of make sure your clients get the most out of their money, kind of compute on both sides and see what
Yeah,
makes most sense to them.
correct. Yeah.
Got it. And now coming to documentation part, what documents do NRIs need to file taxes in India? Sometimes it feels like a hassle. I'm so away right now in terms of knowing what accounts I have, but then additional burden that comes, when I go to a CA is like, hey, how do I get these documents? And sometimes, as you said, it's hard to log in from a foreign country. So how to kind of make this process more easier?
So to make things simple, what you have to do is you should first of all review your 26 AS and TIs. This will give you a fair idea of what all your income sources are, and considering a benchmark on that, you have to see is headwise income that you have. So tomorrow, if you have a house property in India, you should have the asset details available. What is the address of the property? And of course, you would have tenancy contracts available. So that should be made available to understand who is your tenant, what is the rental income you are getting, and plus to calculate the deductions. So this is about the house property. Second, if you have a capital gain. So for example, if you're selling mutual fund, whatever platform you're using to trade would have an option available to download a capital gain report. So we need capital gain report for that. If you are
Hmm.
into shares, it is called as P&L report. If you are into PMS, it is called audited report. So we need these reports basically to ascertain what is your capital gain and dividend income. So it is reported in that. The third category is what we require is the bank statements. So NRO and NRE, we scrutinize all the debit and credit while we are ascertaining the computation of the income tax return. We see all the income that have been credited. First of all, what is the nature
Hmm.
and include in the computation of income. And apart from the bank statement, we require you to get the interest certificates from the bank. That is where we get to know what is the total interest you have got in NRO account. That is part of your total taxable income. And if it is NRE and FCNR, of course, it is exempt. We can declare that as an exempt income while filing the Indian income tax return. So that is also a good idea that
Hmm.
include your exempt income in the Indian income tax return, because eventually you are building more financial transparency and you have a better record available.
Hmm.
And plus, basically, if you have sold a property, there would be calculation of capital gain. We need purchase deed and seal copy. So we have simplified the way how we collect the information and compute the income tax return. So it is not very bothering. Primarily it looks, but eventually it is very simple to collect the documents and everything is digital. You get most of the things online.
Yeah, I think that's the best part now. Like I remember filing taxes for the past 2, 3 years, and it has been a more easier process compared to many years before that. And I think that's a good move, both in the government from the government side, and also there are a lot of platforms that are getting digitized right now. Great. So also quick thing, like a lot of non-residents sometimes believe that they have to report their income in their foreign country. For example, I'm living in the US. Am I required to disclose income, or is it even taxable in India? And in what case it could be? Let's say if
Primarily, there are four things a month. One is your Indian income, second is your Indian asset, third is your foreign income, and fourth is your foreign asset. While you are a non-resident Indian, it is only important that you declare and file for your income in India. So this is the most important thing. And additionally, you should have your assets being reported in India for filing income tax return as a non-resident Indian.
Hmm.
Tomorrow, if you become a resident of India, in that scenario, you will have to declare all four: your Indian income, your foreign income, Indian asset, and foreign asset. That is very important for the returning NRIs, because if you are a resident of India and if you don't include your foreign income and foreign asset while you are filing ITR India, you are
Hmm.
directly covered under the Black Money Act, and the penalty is straight rupees 10 lakh per annum. So it is a huge penalty even for a nominal asset if you have missed upon declaring. So that even includes your insurance policy, which
Hmm.
has a surrender value. So you have to be very cautious, especially if you are migrating back to India. It is very important your income tax return is done in the right manner.
Hmm. Yeah, I think this is a great point. A lot of people miss out on that. Like, hey, I have moved back from, let's say, US to India, and what is in the US, it's in the US, and why do India needs to know, especially if they become a tax resident of India. But as I understand, it's extremely important, and especially if you become a tax resident, India has this right kind of a policy that they must declare, I mean, the residents, that what they have in the foreign countries.
Right, yeah.
So how does, for example, um, uh, NRIs report capital gain on Indian shares and mutual fund?
So primarily it is based on the report that we get. So there is an option where you can download the detailed report. So if it is shares, it is called as P&L report. If it is mutual fund, it is called as capital gain report. First of all, we see what is the period of holding. So if it is more than 12 months, it is classified as long-term capital gain. On that, you have to pay 12.5% tax. If it is short-term capital gain, wherein your asset is holded for less than 12 months, it is classified as short-term capital gain. On that, you have to pay 20% tax. Whereas if it is a debt mutual fund, irrespective of the period of holding, it is taxable as per the slab rates. So India has a progressive slab rate. So for every income category, there is a rise in the percentage of the tax eventual.
Now, quickly I just got reminded of when we are talking about the foreign income asset, the concept of DTAA, which is like double tax avoidance agreement. So, how does this work in place? A lot of sometimes non-residents believe that I pay taxes here, I should not be paying taxes in the US, but what matters is basically you're paying the extra or excess tax rate, right? So, could you help us understand more on this DTA, and also maybe give couple of examples? It works differently for different countries. So how does, like, maybe take two examples about US, and one could be UAE where though you don't have any tax. How does DTA play in both these scenarios?
So DTAA, if you see, India has signed this double tax avoidance agreement with almost 90 nations. And
Hmm.
if I have to give you how this benefits, let me take an example which is very hot right now, especially for the NRIs in the Gulf, it is said, or Singapore for that matter, or Saudi, or the NRIs having mutual fund income are not liable to pay tax in India if they are a non-resident of these countries. So this is what the interpretation of the double tax avoidance agreement is, and which has been backed by the recent tribunal judgment as well. What does the requirement says? You should be a resident of the following the countries wherein the benefit is available. First of all, like if I have to give an example for UAE, you should be a resident in UAE. To qualify as a resident of UAE, you need to spend more than 180 days over there. Condition number two is you should have a TRC. TRC is a which you need to get from the Ministry of Finance or Taxation department over there. And before filing income tax return in India, you need to file for a Form 10F. Based on these things, your income, your capital gain from mutual fund would be exempt in India. But obviously, if TDS is already deducted on that, you can claim it as a refund.
Hmm.
Otherwise, if you have a TRC available and you inform the fund house, in that scenario, they won't be deducting the TDS on that. However, that is a rare case because TRC you are eligible only when you qualify for the number of days required you stay outside India. So yeah, you can claim it as a refund. Second advantage that you get is a reduced tax rate. Like I said, for dividend, it is taxable at a rate of 20%. If you are a resident of UAE, it is taxable at 10%. Interest income, which goes as per slab rate, highest being 30%, is taxable at a reduced rate. So you have to see the double tax avoidance agreement with all the possible countries. Now, if I have to give you an example for US, so India and US double tax avoidance agreement doesn't talk about the mutual fund. So for the NRIs living in US, mutual fund is taxable in India. But the benefit they can derive from having this double tax avoidance agreement between India and US, plus they have the TRC, is they can get a reduced tax rate on the interest and the dividend. So it is at 15% for them.
Hmm. Hmm.
So the advantage can be taken. Similarly, there is a India and Singapore double tax avoidance agreement. So there are advantages available for the respective countries.
Understood. And essentially, having this TRC or tax residency certificate helps or allows them to have a lower tax rate, particularly in certain countries, as you kind of mentioned about the UAE, where mutual fund taxation is almost zero. I mean, like basically, there is no capital gains tax, and even in India, it would be zero in that case.
Correct, correct. So primarily Indian UAE says capital gain would be taxable in the country where the individual is resident. And since UAE doesn't have any taxes, that is how it gets exempt. So tomorrow if UAE comes up with tax, of course it would be taxable over there.
Hmm.
But as of now, there is no personal income tax in UAE.
Got it. Okay. And coming to the property sale, so you mentioned about a lower TDS, so or lower TDS certificate. Could you elaborate more on that? Like, what is exactly a lower TDS certificate, and how can an NRI particularly get it?
So I will tell you first what are the rules for resident, and then I will tell you what are the differentiation in NRI selling a property and how we can help them in getting the lower TDS certificate. So let us understand first what are the rules for resident. So any individual who is resident of India is selling a property for a value which is over and above 50 lakh. The buyer requires to deduct TDS at a rate of 1%. So if I'm buying a property from resident for say example 1 crore, I will pay 99 lakhs to him, and 1% of 1 crore, which is 1 lakh, I will pay to the government of India on the seller's behalf, which he would be filing and claiming the benefit because this is part of his total taxable income.
Right.
The rules are way different for a non-resident Indian. For the very reason you are outside India, the government doesn't have a jurisdiction over you, and the government has an intention to recover the tax that is due to you. So what does the government says? We would apply the highest possible tax rate of the withholding tax on the transactions done by the NRI. So if
Hmm.
you are selling a property for any value in India, what is the long-term capital gain tax you have to pay? It is 12.5%. So government says we will apply 12.5% on the sale value because the buyer doesn't know what is your gain. What they know is the sale value, and the compliance can be done based on that. So irrespective of your gain, even if you're selling a property which is maybe at loss, you have to pay TDS at a rate of 12.5% plus surcharge and plus education cess,
Hmm.
depending on the sale value. So highest being maximum is 16.25%.
Hmm.
So tomorrow if I'm selling a property which is about 2 crore, 16.25% is the withholding tax would be applicable. But if for example, my tax liability is just rupees 5 lakh on a sale value of 2 crore, in percentage term, what it means, it is hardly 2.5%. But what would be my withholding tax? It would be 16.25. So what is happening now is around 14.5% is being excess withholded by the government. What
Hmm.
option I have is the moment I identify a buyer, I apply to the income tax for a lower TDS certificate, telling him that see, this is the buyer, this is the sale value, this is my purchase value, this is my computation, and my net tax liability is just 2.5% on this transaction. On being satisfied, Income Tax India will issue you a lower TDS certificate mentioning the rate to be 2.5%. You give the same to the buyer, and buyer will deduct only 2.5 and not 16.25 if the same example continues. I have a very good expertise, Hemant, in this
Yeah.
part. My office does daily one case on an average. So average time otherwise which it takes to get the lower TDS certificate is 45 to 60 days. And we have an experience of getting the lower TDS certificate in a matter of 1 week also. That is how our experience and expertise comes into play.
I think this is game changing because the solution and particularly the concept is so powerful, I feel, especially for the non-residents, given how it applies differently to residents and then the non-residents. And I think it totally doesn't make sense. Like if someone is selling a property for a crore, you are paying 16 lakhs upfront without even assessing what is the capital gain. And if it case in case of a loss, it is, I think, a moot point to kind of pay upfront the tax and then maybe recover this as a refund 1 year or more, basically in a longer time frame?
Absolutely, Hemant. If you're selling a property, this could be probably a reason you need the money. So,
Mm.
what if your family is in distress? You need the funds available to pay off your children's education or any commitment that is to be done. So, the money is required at that moment of time. Probably that is why you are selling the property. So, that money, what you owe, should be made available to you right at that moment of time. So, for that reason, NRIs should take the benefit of applying for a lower TDS. And further to add this, a lot of people do ask me, Ajay, if I'm selling a property in India, can I remit this money outside India? So as a non-resident Indian, you can remit up to 1 million USD per annum per person to your home country. Of course, there is a compliance. Form 15CA is required, which is an online income tax form. And second is Form 15CB, which is a chartered accountant certificate. You give these two documents to the bank, and bank upon validation would remit the funds from your NRO to NRE or from NRO to your foreign bank account. Limit is 1 million USD per annum per person.
Got it. And slightly going into that a bit more deep, there is a concept of LRS tax, liberalized remittance scheme. And many times NRIs confuse this LRS with this 1 million. So could you share more light on, does this LRS really affect NRIs? And if not, what is the real number? And as I understand, it's 1 million.
So NRI primarily are governed under the $1 million scheme. As a non-resident and you have your own money available in India, you can remit up to 1 million USD. LRS is primarily applicable to resident Indians sending the money outside India. So if I'm a resident of India, I'm allowed to send only 250,000 USD per annum outside India, subject to TCS, which is as high as 20%. So tomorrow, Hemant, if I'm sending you any money, on that LRS would be applicable and the limit is 250,000. So primarily as a non-resident Indian, directly it doesn't impact you. But in case you have an individual who is maybe a relative and who is a resident India sending you money, in that scenario, indirectly LRS affects you.
Hmm. Hmm. Yeah, I think I've seen a lot of residents making these transactions. They either send it to parents or they even sometimes send it to friends from US or from a foreign country to India, and then may also have these transactions between each of their accounts in India. What is the right way that you recommend when it comes to peer-to-peer transactions so that there is a good trail that can be set up, but also at the same time, government doesn't come back to you with a notice that, hey, you're moving money like this. Is that legit or not?
So primarily, if you're sending the money, what route we suggest is from your foreign bank account, first you should transfer it to NRE, and from NRE you should do the further remittance to the individual's account in India. So you have two options: either transfer to NRO and from that account you transfer to the Indian account, because in case you want that money to come back to you, money will come only to your NRO account in India. So
Hmm.
it is always good that debit and credit happens in the same bank account, so that maintenance of bank of accounts and books are very easy comparatively. You have the trail available in the same bank. You can see the debit and the credit.
Hmm.
In case you want, you have both the options available. You can send the money from NRE and NRO both. Preference should be sent it to from NRO so that it comes to the same bank account again. And it should be well documented. You should have the details and documents available. So tomorrow, if Income Tax India comes and asks you how did you get this money, you should have the records available to show that this was an income which was paid to them before, maybe as a gift, loan, whatever you are doing. So you should have track record available for the documents showing the debit as well as the credit.
Hmm. Yeah, I think I just want to emphasize this point. People often overlook documenting transactions and hoping, I mean, because in the initial moment, people are like, hey, I want to help this person, or, I want to send this money to someone for some need. And they fail to recognize or document this transaction. And then later, maybe 5 years down, when the loan is being repaid or someone is refunding you that money, that's where I think the problem comes in, and there is no way to kind of track back or have that debit and credit shown up in the account because they might have just sent it directly to the person's bank account. Is that right?
So Hemant, giving this point, I'm remember with a funny joke that I at times make. So if
Yeah.
I ask you what did you have in your breakfast 3 days back, do you remember that?
No, I don't think I.
Even if I ask you what did you have your breakfast yesterday, you will have to take 2 minutes and think what did I really have. The reason I'm asking you this funny question is, see, you are not able to remember what did you have in your breakfast 3 days back. Tomorrow, if income tax comes to you and asks, okay, there was a credit on 15 June 2023 in your bank for 5 lakh rupees where no narration is mentioned. And of course, you don't have records available or you don't recollect where did this money come in. That is where the problem starts.
Hmm.
So
Hmm.
income tax is not asking you to pay taxes on that. They are asking you to justify the source of the credit. So if it is a bona fide transaction, nothing is going against you. But the moment you are not able to explain, the problem starts.
Yeah. I think this is a very important point, and I feel like people should really pay attention how or what route actually they are moving money, especially if they want it back in their foreign country and don't want it any uninvited notices, particularly from the government.
Absolutely. Government has increased the level of notices being sent to non-residents. Any major investment you do in India, so if you're buying a real estate or even for that reason you are doing FCNR, it is good probability that income tax might send you a notice to ascertain the sources of the fund. So they don't have any intention to levy taxes on that. Their
Hmm.
intention is just to identify where did you get this money. It is a bona fide money for which you are doing the investment.
Hmm.
So you should have the details available to explain the nature of the investment.
Got it. Now shifting some gears, I have heard of this term basically advanced tax, and some NRIs may be applicable for this if they have a lot of income accruing in India in each quarter. So are NRIs also required to pay advanced tax in India, and what should be the right strategy to kind of do this?
So very much this is applicable to non-resident also. Only people who are exempt from paying advance tax is senior citizen. So, but if you are a non-resident Indian having a tax liability of more than rupees 10,000, it is mandatory for you to pay advance tax also. However, given the option in case you don't pay, the additional thing that happens is you end up paying interest on your total tax liability. To save upon the interest, you should be using the advantage of paying the advance tax. As an individual, you have 3 quarters, September, December, and March, wherein you have to compute and pay the percentage of the tax as required as an advance tax. This will eventually save a lot of interest on your income. And this is primarily where TDS is not deducted. Otherwise, if your TDS is deducted at a value, it takes care of your total tax liability. So when we calculate the advance tax, we also see what is your total income, what is the TDS, because for NRI, withholding tax is at a higher rate. So probably you are paying eventually more tax as a withholding tax. So you are 99% of the time it is a refund claim always. For
Hmm.
any individual who has a tax liability, he should concern more for paying the TDS, especially when on which maybe the TDS is not deducted.
Understood. Okay, so some closing questions. I know you mentioned some of these things earlier, but just want to re-emphasize, what is the penalty for late filing or non-filing? Sometimes people overlook that and just want to, you to highlight that very clearly.
So first, if you are missing the primary due date of 31st July, you can file ITR till 31st December. That is where the penalty comes in for the very first time. It is ranging from either 1,000 to rupees 5,000 depending on your income. If you miss upon the 31st December, you cannot file for an ITR. Only option available is you can file for an ITRU, which is an updated return, provided there should be a tax payable. It should not be an income tax return where you are claiming the refund. So I will re-clear this point here. You can file ITRU not for the purpose of claiming any refund. So if any excess TDS has been deducted by filing ITRU, you cannot claim for the refund. Only where you can file ITRU is where there is a tax payable, and if it is immediately preceding 2 year ITRU filing, additional tax liability that you pay is 25%, and if you are filing for the fourth year, it is up to 70%. This is a recent amendment. So earlier ITRU could be filed only for 2 years by paying 25 and 50% additional tax liability, which has been now enhanced to 4 years. Third year you pay additional 60%, fourth year you pay additional 70%. That is how you can file the ITR. For any reason you had a taxable income and you have missed filing income tax return in India, and tomorrow income tax knows that you missed and they send you a notice, they do an assessment, they compute your tax liability, you will end up paying penalty, interest, and which is as high as 200% and plus plus always, because there is a component of interest also.
Mm-hmm.
Penalties are very high then.
Yeah, I think the bottom line is simple. Just file your taxes on time and make sure you have a CA who kind of takes care of all your India side, both income as well as assets, and keep you in check with all of these regulations, because tax can be super complex. And I think the last thing you want to do is have a notice come from the ITR department and kind of make you lose your sleep.
So it is very important to file ITR, but also it is what is caution note here is filing the right ITR. So there is a big difference between filing ITR and the filing the right ITR.
Yeah.
So ITR can be filed by anyone. But an individual who understands the NRI taxation rules and regulation, the expertise what he brings in is very important for you to understand that part. So,
Yeah.
because there are a lot of pitfalls, taxation for resident work way different than taxation for non-resident. So you need to be very, you should be in a comfort zone first of all to understand who can help you better, and
Mm.
accordingly you should take the decision.
Now, this is a great point. I know of some friends who have probably filed as residents for many years after they have moved, from outside India. And this is very funny because they are either unaware because they might be filing it themselves and they're like, oh, I am a resident, or I am still, like not a permanent resident in the US. So especially if it comes in the US category, like people are like, hey, I'm not in the US, I'm just on a visa. So I am technically still a resident. And they fail to understand this eligibility, what counts as a resident or what counts as a non-resident. And sometimes they may have some, existing CA in India and they kind of continue to file as a resident return. And I think this brings a beautiful point where every NRI who moves outside needs to really assess and understand, like, and have a expert that really understands their situation better.
Absolutely, it is a need of the hour.
Hmm. Hmm.
And our profession honestly has grown a lot. We have so many opportunities as a practicing chartered accountant. We have 10 different things, and we cannot focus on every possible rules and regulation because things are also constantly changing. You have to be regulated, you have to be updated, and you need a deep study over the subject.
Hmm.
So gone are those days when you could be master of all. So things are not so good now. So you can be jack of one and master of one now.
Yeah, yeah, yeah. That is true. So, any closing thoughts? I think this was a beautiful session. We covered a lot many points on NRIs, filing taxes in India, and also for returning NRIs. I think making sure they are also in compliance with the ITR department. Any closing thoughts you want to share?
Hemant, I can speak on this subject for hours and hours, given the passion for this subject I have. So coming to the first yeah, closing part, what you should be doing is you should spend some time on your income tax India file. What you should be doing is by the end of the May, that is when your 26 AS statement is updated. Take help of your any friend or a chartered accountant in India. Get your 26 AS, get your TIS and AIS, and understand what are the incomes that have been reported on your PAN. What are the compliances around that? Take help of a professional and understand first of all where do you stand. That will help you in easing out a lot of things. Task number one for non-resident Indian should be to evaluate your 26 AS, AIS, and TIS, and that will tell you what exactly you have to do.
Great. Thank you, Ajay. And I also want to share from the iNRI side. At iNRI, we offer India tax filing with experts like Ajay. So NRI is especially using our platform and those who are not using as well. I think this is a great opportunity where iNRI and experts like you are bringing this discussion, very transparently, which was, I don't think, exists or has been existing for a long time. And with the technology and then things becoming more available, I think it is, as you said, is a need of the hour to kind of make this more and more aware for the NRIs, and then ultimately, make them compliant. As
Having seen the platform that you have built, Hemant, the technology that you have put in it, the ease of individual, a layman NRI, to consolidate his the details, you have made a fantastic thing. It is very easy for any NRI to consolidate all the details and pass on to chartered accountant like me. Eventually it is a very smooth process that we have built. So it was a very complex procedure otherwise, collection of the information, consolidating, how to send everything. The way you have put into the Q&A form, I appreciate that part. You have simplified the collection part for sure. And as a chartered accountant, when we get the documents in the backend, it is very easy for us to understand the nature of the sources of the income and to communicate with the client. So my kudos to you for building that technology based collection tool for Rise to File ITR in India.
Thank you, Ajay. And I think this really brings us more closer to our mission where we believe that, every NRI, whether living, any part of the world, should have the right access and also, a more seamless experience when it comes to dealing with their finances, whether in the US, whether in India, or across any borders.
Absolutely right.
So thank you, Ajay, for your time today. Really loved chatting with you and answering these questions and having a fun time along with that.
Always a pleasure. Always good to talk to you, Hemant.
Thank you, Ajay.
Thank you.